Hello, and welcome to the Logistics Management Podcast Series. My name's Jeff Berman. I'm Group News Editor for Logistics Management Magazine and also the Peerless Media Supply Chain Group. Today, it's a real pleasure to welcome Matt Muenster back to our podcast. Matt serves as Chief Economist for Breakthrough, which is out in Green Bay, Wisconsin. Breakthrough is a provider of fuel and freight solutions for shippers. Matt's areas of influence span from forecasting both fuel and freight markets to quantifying global risk factors and connecting macroeconomics with the everyday experiences of shippers. Through research, industry data, and an understanding of market fundamentals, Matt informs actionable strategies for some of the world's largest brands. What's more, his expertise has been utilized in a variety of different publications, including us here at Logistics Management, and Bloomberg, and many other outlets. He has a master's in economics from Bowling Green State and a bachelor of arts in communications from St. Norbert College. Matt, welcome back.
Thank you, Jeff. It's a pleasure to be back on.
Yeah, absolutely. I think this is your second or third time, at least, on our podcast. So we're glad that you keep returning. So that's awesome. So let's start at the top where we have started in the past, Matt. And that simply would be, how are you sort of viewing the freight economy, or the key economic indicators, if you will, as it relates to the intersection of goods movement? So obviously inflation still remains really high, top of mind, retail sales, manufacturing. There's a whole list of things I'm sure we can touch on. So I'll kind of pass things over to you, Matt, and we can just go from there.
Sounds like a great topic to start on. I'd say we're experiencing the ongoing circumstance of imbalanced economic indicators that for the better part of 2 years tend to point in opposite directions at time. It seems the equities market could be booming, but we could be experiencing more intense inflationary pressure. The labor market could be thriving, but we're experiencing a downward trend in consumption. The list kind of has gone on and on over these last couple of years, but I'd say the most recent trends to date and the most recent focus has certainly been on monetary policy. The inflation rate and unemployment rates are trending in opposite directions. We've had inflation coming down, we've had the unemployment rate going up. However, both have met the kind of bounds that I think the Federal Reserve was focusing on for them to begin with rate cuts in the month of September. So expect that is just around the corner. I think there will need to be more open communication and dialogue about the continuation to give the economy some improved sentiment, consumers some improved sentiment, businesses more confidence moving forward, especially in the latter half of 2024. I think when paired, that uncertainty of the monetary policy environment, when paired with the uncertainty of the fiscal policy environment because of the upcoming presidential election, has certainly been a challenge for plenty of businesses who would be involved with the amount of freight tonnage we see moving out in the market. So I think these trends have had a significant impact on the amount of freight we see moving. We're having a healthy peak season when it comes to imports, total freight tonnage. On a year-over-year growth trend, dipped again in the most recent months. I think the latest positive reading was the month of May. At Breakthrough, we're seeing something similar with our total freight shipments, kind of this uneven month-to-month experience in terms of increases and decreases. And so, Jeff, just to summarize that first question and point, we're still experiencing uneven economic indicators, and that's certainly translating into the freight market.
Understood. And you had touched upon peak season there for a moment, Matt. Let's peel the onion on that a little bit, so to speak, just simply because when we look back at the month of July, for example, I believe, based on the data I saw out of the Port of Los Angeles and the Port of Long Beach, respectively, that last month marked the highest volume July for each port in their respective histories. So nothing to scoff at. And I know there's a bunch of different factors going into sort of what we could be viewing as ongoing, really, really solid United States bound import growth, especially in recent months. What are some of the things that you think about when discussing or analyzing the current state of imports? And let's just stick with through July, I guess, Matt, because that's simply what we have data, the most recent data for.
Sure, Jeff. I'd say one important factor, I talked about inflation a moment ago, but one really important factor is wage growth. And we've experienced real wages that have grown over the course of the last uh, better part of 2 years.
Mm-hmm.
So when adjusted for inflation, wages are growing. That's maintained healthy personal consumption, especially uh, on goods in general. We're still seeing real positive year-over-year growth in consumption, and so that's going to push those import numbers up and get to the records you talked about in Southern California. There's some other factors involved with this, such as shippers perhaps changing the timing of delivery of goods. That could be driven by a number of different factors. Of course, we're experiencing some labor market uncertainty with railroads north of the border as of late, with the potential to strike or not to strike, based on what the federal government
Mm-hmm.
ultimately mandates there, I suppose. But there is uncertainty with East Coast and Gulf Coast ports that could be moving some volumes around. The U.S. railroads, although they're coming to agreement, could have had uncertainty later in the year. And then one other factor is there's uncertainty over how tariffs might change. So a unique circumstance, whether we're discussing the Democratic or Republican parties right now, is that both seem to support at least the continuation of tariffs on Chinese imports. However, the extent of those tariffs can change depending upon which party comes to power. And so I think there's some awareness of that. I'm not sure it's impacting uh, volumes materially, but I think it's another
Mm-hmm.
factor to consider.
Okay. And do you think when we look at those import numbers, Matt, an ocean contact of mine had indicated that that is indicative of what he referred to as front loading in terms of, getting freight on the water, cargo on the water that may otherwise have not moved until later, just in the event of these the labor issues you talked about and really tariffs too and the ongoing uncertainty. Do you think there was an increased amount of that this year? And I just asked because while imports are up, consumer spending slash retail sales, I mean, it's okay, right? It's certainly not full tilt by any stretch. So sometimes I get asked that question by people, and I don't always have the best answer. At times there can be, I guess, what would be viewed as a bit of a disconnect, right? When you look at high imports and sort of okay consumer strength. Is that fair?
Yes, I think that's fair. I do want to add, July retail sales did surpass expectations. So
Mhm.
there have been healthy sales. I think front loading is exactly the word to use when describing the strategies shippers could be taking to manage the labor uncertainty, as well as political uncertainty and ultimately tariffs that could come from it.
Okay, understood. So we've touched upon inflation, we've touched upon imports. Let's talk about the other big I word, and that would be inventories. A year ago or so, Matt, it was really front and center in terms of the destocking and sort of inventory imbalance that was happening. Things seem to be smoothing out, I guess, for lack of a better term, or inventories are in a better place, if you will. How do you sort of assess or gauge what's happening on the inventory front? I guess at this time of year is obviously we're probably talking about this at the right time, given that we're still in front of the true fall peak, I guess.
Yes, this is a complicated question because that needs to start with a response of depends what industry you're talking about. So just getting off that last question, talking about retail inventory, retail sales, that is, retail inventories have been trending in the right direction
Hmm.
after their really intense overhang going back to 2022. However, for other industries, it looks a little bit different. Industrial production's down, especially manufacturing of machinery, for example. That's been down. for the last 5 quarters or so, those inventories are going the other way. Those inventories are building. And so sector to sector of the economy, industry to industry, it's a little bit of a different experience. We're experiencing this within our breakthrough ecosystem volume. We look at what industries are providing the most freight demand, and we measure this in terms of total shipments, whether that's truckload or intermodal out in the market.
Yep.
When we look at what sectors are bringing the most demand and year-over-year growth of demand into the market, it's really led by paper and packaging, food and beverage, and retail. Not too surprising, then the laggards are what I just talked about. We're seeing durable goods sectors and some consumer packaged goods, parts of the consumer packaged goods sector lag. And
Okay.
so we are experiencing an uneven experience out in the market, not so different from the commentary I kicked this call off with in terms of broader economic indicators.
Yeah.
When we look at what's really driving freight demand, it's a few industries, while others seem to be experiencing the brunt of those rate increases and ultimately are having a slower time in the market.
Yeah, absolutely. And let speaking of which, bearing the brunt, if you will, let's shift gears for a moment over to the manufacturing slash industrial economy. You can't help but notice when you look at the data from the ISM, and I'm speaking to the PMI on the manufacturing side. I think it's been down something, and you had just mentioned 5 quarters, which is the same duration, basically. I mean, I think it's been down something like or below 50, 50 being the level reading for growth. It's been sub 50 for something like 20 of the last 21 months. We'll have a new reading coming out after the weekend. So it'll be interesting to see where that ends up. But how do you I mean, how much of a concern is it at this point? I mean, it's been a long time, this manufacturing downturn.
Has been a long time. It is creating divergence in sales and inventories for manufactured goods, especially those related to businesses and capital such as machinery. I think it will take longer to recover. It's not just going to happen immediately following a rate cut in September. It's going to need more positive momentum on the interest rate front for this to turn around, for businesses to gain confidence, and ultimately that those sales to pick back up and those inventories to draw. So I do think this is uh, part of the market that'll take more time to turn around and bring that additional freight demand back.
Okay, got it, got it. And then just real quick on the services side, and this was kind of telegraphed, I guess, during the pandemic, because obviously there was really no service economy to speak of for a long while there. And the analysis was sort of, well, when everything reopens, people are going to have all this pent up cash and desire to go to the movies, to go on vacations, to travel, to do whatever. Um, while services doesn't bring with it truly a high amount of freight, it still factors in because it's coming from discretionary incomes. How would you sort of view the services economy now, late into 2024?
It's still holding up. Kind of in a way surprising, but understanding that so much of the U.S. economy is focused upon services, uh, and understanding just where total U.S. growth has been thus far into 2024. I guess I'm not so surprised by the figures, but when we think about where we'd expect consumers spending to taper, uh, it might happen to some services, to especially those that might be of a more discretionary nature. But thus far into 2024, where we do see headwinds, we break down those different categories of consumption. Really finger points mostly at durable goods, less so at services and non-durables if we're keeping to broad categories.
Okay, got it, got it. And then we had talked about tariffs, the Section 301 But let's talk a little bit. Let's expand on just talk more about. We'll kind of make it a two-part question. Obviously U.S.-China relations. There's a lot of tension. You could say they're frayed. We've talked in the past about China plus one, and now there's China plus plus even from a sourcing perspective. And then on the other side of that, you have Mexico, which is absolutely booming, right? In fact, they're our top trade partner now in terms of U.S. bound imports, and I believe so. Let's start with China, Matt. It's a tough story to tell a bit in terms of our U.S. relations with them. What does that mean for sourcing and supply chain operations if we are to truly, you know, move move beyond them as our main source of goods, given all their manufacturing capacity and all the cost advantages and things like that they do offer to our companies, to North American companies, that is.
You mentioned it's been in flux. It certainly has. The 2023 data showed as a percentage of import value, I believe, Mexico's imports took on 3% more share to the US than Chinese imports have. So it does seem we've made that transition into another leading trade partner. I do expect supply chains will continue to diversify, especially with the tension that's built up between US and China on geopolitical nature and generally speaking, between Western and Eastern countries, as we have experienced a more bifurcated world, as it's sometimes been called, especially after
Hmm.
the onset of Russia's invasion of Ukraine.
Yeah.
Tended to get even muddier with conflict in the Middle East. And so just believe that there'll continue to be these precautions taken, diversification of global supply chains. Now, I do
Okay.
want to add that there's plenty of analysis pointing to the amount of freight that perhaps was manufactured in China that's simply moving to Mexico and still remains under Chinese ownership. I can't comment on the amount of freight, although there does seem to be some credibility to some of that occurring. It's a transition in terms of where the manufacturing base is held, less so the actual ownership, perhaps, of the respective companies.
Right. So in the logic behind Chinese based companies doing that and expanding into Mexico, obviously a huge part of that is circumventing tariffs. Is that right?
Absolutely.
Okay. All right. And so all that said, we can expect to see more of that then.
Yes, I think the longer term trend of the value of U.S. imported goods coming from Mexico, you can go back, I believe, to around the time of the financial crisis and begin to see the trend line move higher. Uh, for China's downturn in terms of the share of the value of imports, there's a more recent phenomenon. They had plateaued, I believe, perhaps around 2015, 2018, they had a pretty steady downturn going back to that time and the previous Trump administration tariffs. And so I do expect these trends to continue.
Okay, got it, got it. And we've been covering, and just back to Mexico for a moment. Throughout the course of this year, especially, we've written a fair amount about how many U.S. based companies are either expanding their presence in Mexico or just setting up shop and with cross-border facilities, FTZs, etc. And it almost in a sense seems like it's blowing up. For the longest time, when I first started writing in logistics, we always were talking to people about nearshoring, friend shoring, whatever you like to call it, but you didn't really always see a lot of action behind those words. You're really seeing that action now, right, Matt? I mean, it's kind of, if you take away the election and sort of this labor uncertainty, and you can make an argument it's sort of the hot story in logistics still. It's certainly an interesting one from my perspective. I guess what I'm trying to ask, I'm a little long-winded there, I apologize, but what I'm basically just trying to ask is, if you were to uh equate this to sort of a baseball game, if you will, would we still be in the early innings when it comes to Mexico, or are we working our way up through halfway through the game? Where do you think we are?
That's a really great question. I can't say that I've had one phrased quite like that, but I love the kind of perspective it brings to it all. Uh, well, it seems the progression from China, like I'd mentioned, really accelerated. Well, I suppose going back to the plateaus, we're about 10 years on from that. The acceleration of movement from China, maybe just 5 or 6 years removed from that starting. Um, Perhaps we're in the fourth inning. So
Okay.
I have seen and come across some concerns about the growth rate of the industrial manufacturing base in Mexico, and I guess some analysts pondering Mexico is going to have similar infrastructure challenges when it comes to energy that the U.S. is having in some respects, especially regarding the load of electricity that's needed to power these manufacturing sites and distribution sites. The U.S. is battling it a bit when it comes to our the build out of charging infrastructure, for example, and just having a dated grid. Mexico's going to need to invest presumably tens of billions of dollars by some estimates by the end of this decade in order to meet the demands of this growing industrial base. So I think there are questions like those out in the marketplace that will make us wonder about the rate of change. Can it be maintained at this level, or will it naturally need to slow? And I do think there's a point not so far in the distance in which it will need to slow because of some of this eventual friction to growing at such a rate.
Okay, got it, got it. And just to wrap up here, Matt, just a quick one. I think the last GDP estimate I saw, I don't know if it was the final number. I think it was 2.8, if I'm not mistaken. And it's it's been down. It seems to it's kind of inched around like high twos for a while now. Um, where would you be if we were to look at GDP on balance? I mean, what would be a good sustainable reading uh post rate cut should things really should we get some good economic momentum subsequently after that? In other words, where would you like to see GDP in that would speak to a healthier freight economy?
Well, long term, sustainably, I actually think 2.8 is a little bit high for the US, sustainably
O-
speaking. I,
Okay.
I expect the next couple of quarters we'll see some uh, headwinds in the end of 2024, beginning of 2025, in terms of the overall GDP figure, that there's going to be a lag from the time it takes for those interest rates to be cut to the time that it'll actually have an impact on the broader economy. But then, yes, sustainably, you'd like to see that number remain above 2%.
Okay, got it. Got it. All right. Well, look, Matt, we reached the end of our allotted time for today's podcast recording. So, on behalf of Logistics Management Magazine and the Peerless Media Supply Chain Group, I'd like to offer up a big thanks for you spending some time with us today.
Jeff, it's been my pleasure. Thank you for having me on.
Yeah, absolutely. And for those of you out in the audience, if you want to connect with Matt, he is on LinkedIn, so you can find him there. It's Matt Muenster, Muenster. And you can also find Breakthrough, the company that is also on LinkedIn, and are also on Twitter, simply at Breakthrough NA. And you can also find us at Logistics Management on Twitter. It's at Logistics MGMT. And if you're not signed up for our podcast, please just go ahead and search for Supply Chain 24/7 wherever you get your podcast, and it should pop right up. Thanks, everybody. Have a great day, and we'll talk to you next time.